Where is ETH headed? It's a question that's on a lot of people's minds. Indeed, it has been a pretty crazy past few months as ETH has broken new all-time highs, despite some serious scalability concerns. Now, it's a topic that I have covered ad nauseam on this channel, a trend that I've been talking about ever since ETH was trading at below $200. So, is there still upside potential? Well, that's exactly what I'll be covering today. Not only will I be taking a look at some of the most important developments in the Ethereum space, but I'll also be explaining how ETH is valued, something that can help you determine whether it still has legs to run. Oh, and I also have a new price prediction for you folks too, so you definitely want to stick around for that. Not to leave you in suspense, but before we commence, I have some disclaimers I need to dispense. Although I may make you wiser, I am not a financial advisor. Everything you're about to see is for educational and informational purposes only. It is NB that you DYOR. Also, FYI, transparency is my MO, and I hold ETH in my personal portfolio. Now, with that out of the way, I'd like to say good day to all the new viewers here today. My name is Guy, and I am the Crypto Guy. Over here at the Bureau, I cover everything, well, crypto. News, reviews, and overviews, all mixed together in a highly digestible and friendly form. So, if this is something that you can get on board with, then grab your ticket by tapping that subscribe button. Be sure to also ping that ringing bell to turn on all those notifications. It's the best way to make sure you get the videos the moment they hit the tube. One more thing, if you will direct your attention to the video timeline. As you can see, it is broken up into different sections. And that is all for you folks to skip around if there's a topic that interests you the most, although I do encourage you to watch as much of it as you can. Okay, that's quite enough of my nattering and pitter-patter. Let's jump right in. The first and most important thing we have to ask ourselves is why ETH has value. Indeed, I've seen very few theoretical frameworks out there for valuing something like ETH. Now, perhaps one of the most relevant that I've seen is that of the FAT protocol theory. This was an investment model that was first popularised by Joel Monegro over at Union Square Ventures, one of the most well-known VCs in the world. It's based on the notion that Ethereum has built a protocol that is most able to capture value, hence the term FAT. The best way to think about this is to view it in the context of some of the most established networking protocols out there. Now, perhaps the most well-known of these is TCPIP. For those that don't know, this is the protocol that has allowed the internet to function. Without it, the internet would just not exist. However, despite the immense importance of the TCPIP protocol, it has failed to capture any value for the network layer. All of the value accrues to those applications and websites that are built on top of it. Think Facebook, Amazon, Google, etc., etc., etc. The protocol layer is thin in value, whereas the application layer has captured all that value and has become fat off of it. However, when it comes to decentralized blockchains, that relationship is reversed. The protocol layer is able to capture a lot of the value that has been built on top of it. In this case, the application layer is all the dApps that have been built on Ethereum. The main difference between these dApps and the apps that are built on the traditional internet is that they cannot effectively silo their data and value. Think about it. Facebook is valuable mainly because of all the data it holds, when it's not being hacked and leaked on the dark web, that is. However, when you're building an application on the decentralized Ethereum network, your dApp data is open for many to see. Smart contracts are open source and anyone can audit them. They can see exactly how it operates, and the value that a dApp is able to capture is to some degree shared through the entire network. Essentially, value is able to trickle down from the application layer to the protocol layer. So, how does this apply to the value of ETH? Well, Ether is the fuel that underpins the entire Ethereum network. You need ETH in order to pay for gas to run computations. This means that the demand for ETH is inextricably linked to the amount of use on the Ethereum blockchain. There is no sort of transactional medium on the traditional internet. There are no real monetary mechanisms required to build on top of it. This is another reason why the TCPIP protocol is thin in value. So, by owning ETH, you effectively own a share in the success of the underlying network. Now, imagine if there was an option to own a share in the Internet Protocol back in 1990 when it was in its infancy. Can you imagine the value that would have accrued if that was the case? This is the way that I currently view ETH and its role in the Ethereum network, a rare fuel that will be needed to power the future Internet of Value. Okay, so that's a rough overview of the FAT protocol theory. I've linked to the full blog post below should you want more information on it. Now, while the FAT protocol theory is most applicable to the blockchains like Ethereum, there are other pretty established general network valuation models out there. One of the most well-known is perhaps Metcalfe's law. I won't bore you with all the details, but it basically stipulates that the value of a telecommunications network is proportional to the square of the number of connected users of the system. So essentially, the value is an exponential function of the users on the network. Many people have tried to use Metcalfe's law in order to derive some sort of value for the Ethereum network and hence ETH. However, I prefer to use Metcalfe's law in conjunction with the FAT protocol. Namely, both models broadly dictate that the more uses there are, the more valuable it is. So we have to assess how much demand there will be to use Ethereum, i.e. network demand. Recently, the Ethereum network demand has been surging. You only need to take a look at the total number of active addresses on the network. As you can see, this is at an all-time high of over 580,000 addresses. So, what is driving all this demand? Well, it comes down to three main factors in my eye: DeFi, Stablecoin Demand, and NFTs. Let's start with that first one. Take a look at this graph. It's the total value locked, TVL, in DeFi smart contracts. It's currently at all-time highs of over $52 billion at the time of this video. DeFi has been one of the biggest drivers of Ethereum network demand over the past year. And here's another graph that we can use to illustrate that. It's the total number of DeFi users as defined by unique addresses. That, my friends, is looking increasingly parabolic to me. These addresses are using DEXs, lending protocols, yield farming platforms, and other DeFi tools. They are the dApps that are being built on the Ethereum network and are making the protocol layer fat with value. This is also because of how interoperable these different platforms are. Given that they're all built on the same network layer and are open for use, all of the value and data generated on one platform can be used in another. It's quite the opposite that we experience with walled data gardens in the traditional internet space. So, that's the DeFi demand, an Ethereum network use case that I don't think is likely to start slowing down anytime soon. Moving on though, let's take a look at that stablecoin demand. It's quite clear that Ethereum is the predominant settlement layer that has been chosen by stablecoin issuers. Here you have the total stablecoin supply that has been issued on the Ethereum network. Almost $45 billion at the time of this video. Tether, USDC, Paxos, Gemini Dollar, the list goes on. All this stablecoin demand, of course, means demand for the underlying transactional layer and ETH to pay those gas fees. And if you think that this stablecoin demand is high, I have news for you. It's about to skyrocket in the coming months. That's because of a number of factors. Firstly, in the case of Tether, they have officially settled with the New York AG on that outstanding lawsuit. Moreover, they have become that much more transparent with their reserves, as they have recently issued attestations. Both of these remove a certain degree of risk that was always associated with using USDT. However, the bigger story is, of course, that USDC demand. As we can see, the supply growth of USDC is overtaking Tether. This is because numerous exchanges and crypto businesses would prefer to use a fully regulated US dollar-backed stablecoin than one that is based offshore like Tether. This is further evidenced by one of the most exciting announcements recently by USDC. That is, of course, the news that Visa would be integrating USDC into its payment networks. I can't overstate the importance of this. Visa has over 46 million merchants worldwide, and they transfer over $11 trillion in value on a yearly basis. Crazy numbers indeed. Now, of course, Visa had to choose a settlement layer in order to process these transactions. Which network do you think they used? That's right, they went for Ethereum. Indeed, this was something I predicted may happen in my video on Ethereum at the beginning of the year. Think about this. Every transaction that will be settled in USDC on the Visa network will need ETH in order to pay gas fees. Visa will need to purchase Ether in order to pay for these gas fees, ETH that they're going to have to buy from folks like you and me. Okay, so that's stablecoins. Despite numerous options for settlement layers, these companies are still opting for the dominant smart contract blockchain in the space. And speaking of credit card processors, MasterCard was not sleeping at the wheel either. It recently announced that it had partnered with Consensus to use Quorum for its multi-blockchain strategy. For those that don't know, Quorum allows enterprise clients to leverage the Ethereum blockchain for their internal networks. That's more network demand and hence more value for ETH. Anyway, that's stablecoins and transactional demand. There is one more massive demand driver for Ethereum usage at the moment, and that is, of course, the NFT craze. So, let's take a quick look into that. Now, I assume you all know what a non-fungible token is at this point. If not, my video on NFTs is just what the crypto doctor ordered. That's in the top right. NFTs are essentially unique tokens that are issued under the ERC 721 token standard. They've been used to issue everything from collectibles to digital art, blockchain domains to music. And to say that there has been an explosion in NFTs this year is an understatement. Everyone is trying to get on board the NFT train. Of course, this crazy demand for NFTs means that they have to be issued and traded on an underlying network. The overwhelming majority of NFTs are issued on the Ethereum blockchain. Therefore, this means more demand. Minting NFTs on the Ethereum network is done through smart contract executions. These require a lot of gas to execute. And similarly, once it's been minted, sending it is similar to sending any other ERC20 token. You will have to pay gas costs. As we know, this gas is paid in ETH. More demand to mint and send NFTs means more demand for the underlying ETH. So, NFTs are providing yet another level of value for Ethereum according to the FAT protocol theory. Not only is it acting as the transfer protocol for the multi-billion-dollar decentralized finance ecosystem, but it's also becoming the de facto network for all unique assets. Is this trend likely to continue? Well, there are signs that the NFT market is looking a little bubbly. There have been some price falls in some of the most expensive NFT collectibles. However, I happen to think that in the long run, NFTs are going to be a game changer. They have already demonstrated their use cases and have captured the attention of some of the most well-known and respected artists. Yes, there may be a slight consolidation, but all markets go through these types of cycles. And as the NFT sector continues its adoption drive, so too will there be demand to use the Ethereum blockchain. Now, having said all of this, I would be blind not to address the side effect of all this network adoption: extreme blockchain bloat. Bloat that not only slows the network, but also leads to insane gas costs. Both scaling side effects that limit the adoption potential of Ethereum for smaller hodlers and users. So, where the hell is Ethereum when it comes to addressing these scaling issues? For those of you who watched my previous video on Ethereum scaling, you'll have seen that I was quite optimistic about optimistic rollups. If you don't know what these are, then I highly encourage you to watch that video. Top right, por favor. Now, in that video, I was quite optimistic about optimism. That's because it was slated to launch its mainnet in March of this year. However, that appears to have been a little over-optimistic. It has had to delay its mainnet launch till at least July. So that is a bit of a disappointment, as there were many who were looking to optimistic rollups to be a premier ETH Layer 2 scaling solution. However, Optimism was only one of the many Layer 2 scaling solutions that were being worked on. Another very promising project is, of course, Polygon. Now, this used to be called the Matic network, and it has developed a child chain architecture that leverages ZK rollups and optimistic rollups. What's important to note about this is that unlike other sidechain solutions, Polygon child chains will be able to leverage the security, robustness, and network effects of the Ethereum blockchain. There has already been a lot of adoption on this front, as numerous projects have announced sidechain integrations with Polygon. Some of the most well-known include Aave, one of the largest DeFi lending protocols. Now, on top of that, Layer 2 DEXs on Polygon are picking up steam. Here you have QuickSwap, which is a Uniswap clone that's run on Polygon. It already has over $111 million in TVL locked up and has the most trading volume of all Layer 2 DEXs. Of course, given that this is Layer 2, it means that scaling can be done off of the main chain. As more Ethereum dApps start to integrate with Polygon, it will mean less bloat on the main network. I should also point out that apart from Polygon and Optimism, you have a number of other Ethereum Layer 2 solutions that are being worked on. These include the likes of XDAI and Loopring, to name but a few. And despite the delay with Optimism, I don't doubt the ability of it to eventually help Ethereum scale. For example, projects like Synthetix and Uniswap have already integrated their platforms into the Optimism testnet and will likely be deploying on the mainnet when it goes live. The only concerns that are currently being voiced about Layer 2s are that they're not as secure as the main Ethereum network. However, I think that this tweet by Anthony Sassano on Twitter best sums up that view. Yes, the narrative is changing, and that is, of course, progress. However, all this talk of Layer 2 solutions belies the fact that Ethereum is going through one of its most radical transformations ever. That would be ETH 2.0 and its accompanying upgrades. So, let's take a quick look at all of it. Although Ethereum just went through the Berlin upgrade a few days ago, perhaps the most anticipated upgrade is the London upgrade, which is slated to take place in July. Now, besides London being a cooler city than Berlin, Entschuldigung Berliner, the London upgrade will include the much-vaunted EIP 1559. Now, I've gone through this improvement proposal ad nauseam, but it is basically a change in the way that the Ethereum gas fee auction market works. It will see the implementation of a standardized base fee and an optional tip that can be paid to speed up transactions. This base fee will then be burned, which has important implications for the tokenomics. More on those in a bit. Now, while EIP 1559 may not necessarily reduce gas fees per se, it will make them more predictable and easier to use. You won't need to adjust gas limits based on current market conditions, as the base fee will be dynamically adjusted. Of course, given that the base fee will be burned and not accrue to the miners, this has led to quite a lot of rebellion from them. While some of their concerns about security may be justified, it's further proof that Ethereum just needs to hurry along with that move to proof of stake. And speaking of which, that is exactly what they are doing. The Ethereum developers have been discussing fast-tracking the proof of stake merge ahead of the other ETH 2.0 stages. Essentially, they're looking to move the merge to phase 1 of the roadmap, which was originally scheduled to be the point at which sharding is implemented. Now, I happen to agree with this proposal. Although sharding is important for the scaling of the Ethereum network, numerous shard chains, the main sticking point right now is the slow proof-of-work consensus method. This idea of a, quote, quick merge via fork choice change is something that was proposed by Vitalik in this following note he wrote. So, the VDog himself is also in favor of moving the proof-of-stake timeline forward. Now, what will proof-of-stake mean for the network? Well, it's generally able to come to a decentralized consensus about the state of the blockchain much more quickly than a proof-of-work method. Unlike miners, proof-of-stake validators vote on the correct state of the blockchain. I've linked to some additional resources below should you want more information on that. The main point to take away from this, though, is the fact that this could supercharge Ethereum scaling, and it could happen this very year. And This scaling will mean that Metcalfe's law will lead to an exponential valuation. Let's also not forget the additional value that will be captured by the tsunami of dApps that will be built on Ethereum. Now, this is all well and good, but what does it mean for price? Well, the first thing to note is that price and value are two separate concepts. The former is driven by current market trends, whereas the latter is driven by those fundamental factors I mentioned above. In order to assess the short-term price potential of ETH, we have to take a look at some of the demand and supply factors driving it. There are two demand-side factors here. One is the utility demand I talked about before, demand for ETH to pay gas fees in DeFi, stablecoins, and the NFT markets. The other is investment demand. This has been on the uptick this year as a number of institutional investors have started to diversify their Bitcoin investments into the premier altcoin on the market. So, we have increased demand for ETH from both sources. Let's hop on over to the supply side, shall we? Here we have the total percentage of all ETH that's being held in exchange addresses. As you can see, it has been on a sustained downward trend ever since August of last year. This all shows that there's less supply available on the market to sell, and hence a lack of sources of downward price pressure. But where is this ETH going? Well, let's overlay that exchange address chart with the total percent that's being locked in smart contracts. Notice a trend? That's right. It's almost as if they have a perfect inverse relationship. Money flowing off of exchanges tends to be heading towards smart contracts. These smart contracts include the likes of the DeFi ones I mentioned earlier, as well as the ETH 2.0 staking contract. The latter already has over 3.8 million ETH staked in it, and it's still climbing. I should also add that deposits that are locked into this staking contract are really locked. That's because once ETH is staked in the deposit contract, it cannot be removed. Hence, it's a lot more sticky than the ETH that's locked in other DeFi protocols. Okay, so that's two of the most important supply factors now. But of course, you can't forget the impact of EIP 1559. Should this be implemented in July, it will mean that ETH will be burned with the base fee. This could dynamically cap ETH supply and eliminate inflation. In fact, if network demand is extensive enough, something which this video should have made clear, we could actually see deflation in ETH. Yep, the fee burn is so large that it offsets all inflation. This was also a point noted by Vitalik in an interview he did on the Tim Ferriss podcast recently. Quote, if Bitcoin and its fixed supply is sound money, then if you have a decreasing supply, does that make it, Ethereum, ultrasound money? Food for thought. So, let's bring this all together. You have increasing utility demand, increasing investment demand, decreasing exchange supply, more ETH in DeFi smart contracts, more ETH in the ETH 2.0 deposit contract, and potential impact of fee burns. Now, I don't think you need to be a Milton Friedman to know that that means an increase in ETH's price. How much, do you ask? Well, it really depends on a number of factors. Options markets have most of their call trades with a strike of ETH at $3,000 at the end of May and above $4,400 at the end of June. The pricing of these strikes is most likely as a bet on the implementation of EIP 1559 in July. However, given all the factors that I've mentioned, it doesn't seem that far from reality. Time to wrap up, because I know unless I stop myself, I could go on talking about Ethereum forever. That's just because Ethereum really is so exciting. I view it in the same way that those internet pioneers viewed the TCPIP back in the 1990s. However, this time around, we have an opportunity to invest in a protocol that has that much potential. As theorized by the Fat Protocol theory, Ethereum is well positioned to capture the value that's being built on top of it. And as the fuel that powers the network, ETH is becoming an incredibly rare asset. The more that the ecosystem grows, the more demand there is for ETH to power dApps and facilitate transactions. Yes, scaling is currently a concern, but people who constantly spin this narrative are intentionally ignoring the extensive work that's being done on scaling solutions. Scaling solutions that include not only work on Ethereum 2.0, but also on Layer 2 solutions. As these solutions are rolled out, it could further increase demand on the Ethereum network. Besides that, you just have a massive disparity between supply and demand currently on the market. ETH is being removed from exchanges and locked in smart contracts. All of these are likely to help power that ETH price to new all-time highs. And speaking of prices, it's time now for my own prediction. Well, if the Ethereum developers are able to effectively push EIP 1559 in the London upgrade, then we could easily see ETH above $4,000 before the end of July. Now, that's my prediction as a crypto guy, not a financial advisor. Well done for sticking in there, folks. If you enjoyed the video, then help this crypto bro out. Flick that like button and bash that subscribe button. Oh, and tap that bell. I know you want to. Are you still dying for more content? Well then, have I got a treat for you. Have you heard of my socials page? That's the page that has links to all the other places that you can follow me. These include my Insider Telegram channel for market analysis, my Twitter for daily news and updates, my Instagram and TikTok for behind-the-scenes views and video updates, and of course, the creme de la creme, the pièce de résistance, the weekly email newsletter, which includes my market updates, hidden coin tips, and a sneak peek of my personal portfolio. All of that which you seek is right over here in the description. Okay, that's enough for today, guys and gals. Crypto guys gotta fly. I'll see you all further on down the blockchain.